I was going to separate the last two chapters from Unit 14 and give it its own special treatment. The basically two chapters on what happened in the Great Depression of the 1930s and the Great Recession, which began in '07. First obvious question, what's the difference between a depression and a recession? Nothing, really. In past, depression was considered the worst form of recession. And that still sort of holds true, although as we'll see here as we look at this, in many ways, the recession of '07 was worse than the Great Depression. Although, again, in terms of its lasting legacy, the Great Depression really became part of the national fabric. We're going to take a look at some of the economic causes, and again, we have obviously a little bit more information on the Great Depression because it occurred so long ago. Our economy today is still, in some ways, recovering from the recession of '07. And of course, in 10 years from now, some Econ teachers are going to be teaching students your age about what the great pandemic of 2020 did to the economy. Lots of commonalities. Guys, we're living through history right now. So when we talk about some of the things that we talk about here in terms of what happened, the government's involvement, the government's reaction to these factors, it's happening right now. Different names, maybe, different ideas, different verbiage is being used, but a whole lot of commonalities between what's happening now and what happened during these two other major economic crises. Now, if you've been paying attention at Econ, you'll know that we had significant economic downturns long before the Great Depression came around. They were usually called panics, run on the bank and things like that. In some cases, they were pretty darn sharp, but they were quick. A couple of corrective measures taken, and again, that wonderful supply and demand and free market is the best self-correcting mechanism that man has really ever come up with. And so, while living through these panics and whatnot, recessions beforehand was no fun. Generally speaking, when we compare them to the Great Recession and the Great Depression in the '30s. They were very, very short. The Great Depression began 1929. Black Friday was what it's called, when the stock markets more or less crashed. We'll get to explaining what that means in just a second. Like anything to do with the economy, the causes, the whats and whys, are widespread and complex. People are still debating it today. Again, economics is a very, very difficult science. No one knows it all. Let's look at the few years leading up to the Great Depression, again starting in 1920 and going through most of the decade of the '30s. The U.S. had a fairly prosperous decade in the 1920s. A lot of, remember, the income tax was established in 1913. And so from a government revenue standpoint, that gave the government a little bit steadier form of revenue. We'd gone off the gold standard, so we're printing more money now, and pretty much at this point, paper currency had become the way to go in the U.S. But again, overall, the U.S. was fairly strong economically during the 1920s. During the decade, wages and stock prices rose. A lot of people were beginning to see the stock market, not just corporations, but people, individuals, and small groups of people were beginning to see the stock market as not a get-rich-quick scheme necessarily, but for some they did. They saw these burgeoning companies that they could invest X number of dollars in and then have X times 3 within a couple of years. That happened sometime. So a lot of people started doing something called investing on margin. That is to say, where let's buy 100 shares of Acme. The person puts up $10, their broker puts up $90. So the broker gets 90% of the return or 90% of the loss. A lot of people started doing this, and again, what happens when the demand goes up? the prices go up too. In this case, the stock prices went up. And what happened was they went up so quickly that they actually rose to much higher than their real actual worth. This is called a bubble. You have heard probably that term before. You'll most certainly hear it in a few minutes when we talk about the Great Recession of '07, the housing bubble. In this case, the stock bubble was beginning to form. History repeated itself a few years later, but we'll get to that in just a second. A few people began to notice this and started backing off. The speculative bubble burst October 29th, 1929. Stock market lost 13% of its value in one day. By the end of November, just 1 month later, the stock market had lost 40% of its value. A whole lot of things like this had happened before, but never to this degree. Now, the great debate we have going on now is, why was it so darn bad in 1929 and 1930? A lot of economic historians agree that this marginal investments, the ones we talked about just a minute ago, where the person would, hey, I'll throw $100 into this. My broker invests $900. We got a $1,000 investment in the Acme Corporation. A whole lot of that was going up. So because the demand went up so sharply, prices went up sharply, that bubble formed and it got big in a hurry. And when it burst, it was going to be a bad one. And of course, everyone thinks it's going to burst for the other guy, not for them. I'm going to take a chance. It's going to work for me. It's going to bust down the road sometime, but I'll be long gone out of it. That's what everybody thinks, and history repeats itself. The economic impact throughout the country, people, it's kind of popular to think that after Black Friday, the big Dow collapse, that immediately everybody began standing in soup lines and Dust Bowl and all that. Now, the impact was much more gradual than that. By the end of 1930, though, with all of that loss of real value in the stock market, things really started to get into a classic downturn. Unfortunately, the response of the government was a textbook case in what not to do in a downturn. One of the problems with all this, the biggest problem really, was that because of the undervaluing of the market, banks all of a sudden, for obvious reasons, got very stingy about loaning money to new companies. And again, that is the lifeblood of a capitalistic economy, that access to capital. You can't create a business, a money-making enterprise out of thin air. You have to have an initial investment of some sort. And again, banks, lending institutions have been the source of that. Again, you put money in the bank and draw 3% interest because the bank can loan that money out at 6% interest, and they clear the 3%. That is the lifeblood of this of the money economy, as we call it. President Hoover, at the time, proposed an increase in tariffs to protect American industries. Again, trying to look out for us. Unintended consequences kicked in very quickly with the Smoot-Hawley tariff that passed Congress in 1930. And actually, the provisions went much further than even President Hoover wanted. The obvious result, a sharp drop in trade with other countries, which means those American companies that were trading with the other countries, all of a sudden, they were losing more money. Businesses, again, were still having trouble borrowing money from banks. Banks have to remember, keep that so-called fractional reserve basis. Again, they got to have a certain amount of money available just in case it hits the fan. Well, they simply did not have enough cash to meet depositors' demands. And again, the cascade effect really kicked up then when businesses, new businesses and existing ones, no longer had good access to capital. Congress raised income tax rates in 1931, a purely selfish move which was designed to do one thing, to make sure the government got their funding. Again, people were paying less in taxes because they were making less money. Well, the government says, we're not going to go broke. Here's a tax increase. Higher taxes do not promote economic recovery. They do the opposite. Every time. People were then we're left with even less in the way of income. 1931, the Fed, trying to do something, raised interest rates again to try to halt the flow of gold that was leaving the country because of all this. And this, too, really hurt chances for recovery. A few charts here I'll share. And you can actually see that there's really the Great Depression included two big dips, the one 1929, 1930, and then the big one in 32, 33. Just as the economy began to show some signs of recovery, then the subsequent bubble burst again. At one point, the stock market lost 90% of its value. That is just an unfathomable number. And again, remember, this was all before FDIC insurance, where your deposits are insured up to a certain amount. So the money supply continued to be completely inadequate. Businesses were not able to expand or even start because they could not get a loan. 1932, the election of Franklin Delano Roosevelt as president. He actually campaigned criticizing Hoover's administration for what he called interventionist economic policy. That is, that government's getting too involved in the economy. Well, then FDR did exactly that times a million. We are familiar, I would hope, with the New Deal. That is a series of government investments in the economy, in jobs, what have you, that by modern day standards would have amounted to trillions of dollars in spending. The Tennessee Valley Authority, so many other entities that just almost doubled overnight the size of the federal government, but the federal government was pumping money into these projects to create jobs, and that's fine. But again, government does not have to abide by the rules of supply and demand. Government pays no price for being wrong. Therefore, when we're talking about economic recovery, if it's coming through the government, it is an illusion. It is short term because they are not playing by the same set of rules. And if we are going to be a capitalistic economy, we have to very, very much temper direct government involvement like this. Now, again, the counter argument is, this is an emergency. We need to do something right now. And yes, I'm not a fan of government getting involved, but by God, we got to do something now. Does that sound familiar? Does that sound like, I don't know, something that might happen during a pandemic? This is an emergency. The two rules of government lovers, those who love government intervention. Number one, in emergency situations, governments can take extra constitutional authority and do things they ordinarily would not be able to do. Rule number two, there's always an emergency. Be careful. The economists today are still debating whether the New Deal was a good deal. Was it a fair trade? Was it worth losing some of this public economic autonomy in order to give it to the government, in order for the short-term blessings of a few jobs and some investment? It goes to one of the very core arguments of the proper role of government in a free society. As such, economists are still debating it in many ways today. Again, very difficult to say because we don't know what would have happened without the New Deal. Would it have gotten better more quickly? Would it have gotten worse? We simply don't know. That is the object of speculation even to this day. There is a couple of things to note. The Depression in the United States, and of course this was a worldwide phenomenon, it doesn't happen in a vacuum. The Depression lasted in the U.S. Several years longer than most European nations, and really we did not get back up to pre-Depression levels until the military production increased during World War II. So did the New Deal help or hurt? Yes. It helped, obviously. Again, you can't sling that kind of money at something and somebody not benefit. But many Americans, because of the New Deal, came to believe that active government intervention in the economy by increasing government spending was the best way out of the Depression. and thus would be the best way out of any issues we had in the future. And that line of thinking has picked up, and it is pervasive today, as we are living right now. Again, this is the Keynesian school of economics, where government investment is the key lubricant to keep an economy engine going smoothly. Again, we can't say for sure what would have happened without the New Deal, because we had a New Deal. We didn't try it without it. Republicans, Democrats, the Federal Reserve at this time all share the blame for bringing the Depression about for first place, and quite frankly for prolonging it here. Actions in the free market and actions by the government probably helped to some degree and probably hindered. Many Americans, again, came to believe that government was the best way out of any economic difficulty. Americans now depend on the federal government to provide economic safety. Again, our age-old debate, freedom versus security. A lot of people lean this way now, and they are willing to have direct government involvement at the expense of tax dollars and at the expense of freedom to grant security. The expanded role of the government of the Great Depression was just the beginning, and we are living in the aftermath of that. Let's move forward a few decades, and the Great Recession, not to be confused with the Great Depression. We had some recessionary activity. Early 1980s was a rough time. Most of the 80s was pretty good. 90s, it amazes me that you guys were not even born during what was called the dot-com boom of the mid to late 1990s. What happened was the internet. Lots of new possibilities were emerging with this amazing tool where computers could talk to each other, transfer information at what we thought were unfathomable speeds. A 28.8 modem? Wow! Yeah. When the internet first started, there were several nascent businesses that started to make a boatload of money. Maybe you've heard of them. Amazon, eBay, things like that. There's a lot that are no longer with us, too. Because this was a new tool with limitless possibilities, people in the economy had been doing well. So there were people who had, I don't want to call it disposable income, but speculative income. Hey, if I invest in $1,000 in Acme.com and they take off like Amazon did, I'm rich. And a lot of people got rich. But again, much like with the Great Depression, that was a bubble. That was a bubble. It kept growing, but there were a lot of people getting rich very, very, very quickly. And I'm talking very, very rich. So people ignored the bubble. I'm the one's going to get rich. The bubble will burst after I get rich. I'm going to read you something in the book which really made subsequently the recession much worse. Imagine that you spend your life up to your chin in water. That's how you live. You become used to it. You forget that this is a dangerous situation. It's how you live your life. In this case, just a small rise in the water level could be fatal. If you're 6 feet tall, up to your chin in water, the water level would only have to rise 10 inches, 16%, for you to be completely submerged. If you're standing on dry ground, a rise of 10 inches in the water level would not even come to your knees if you're on dry ground. With water already up to your neck, though, just a few inches puts you in danger. That's an illustration of the extent to which the American economy was and is dependent on the concept of debt. Large, successful businesses carried billions of dollars in debt. Families like me, living in this nice little house I got here, we're in debt. I did not go to the previous homeowner and cut them a 6-figure check to live in this house. I borrowed it. And again, like so many other people, I'm up to here in debt. That's how, unfortunately, our economy has been structured. The federal government gives us a wonderful example by going into debt every year, deeper and deeper and deeper. Of course, Chucky can't print money. They can. Again, government doesn't play by the rules we are. We have to play by. The book mentions greed also, and again, I'm not going to do a Gordon Gekko here and give you the greed is good spiel. I will again just give you my definition of greed. It becomes greed when you start placing money above God. When you start looking at your wallet before you do God, that's when it becomes greed. But it is seductive. What's the American dream? We've talked about it before. Home ownership. Everybody wanted a home. Everybody still wants a home. The problem was the idea began to emerge that the percentage of people who were, the homes that were owner occupied, was a sign of a good economy. Therefore, if we could get more people to own their homes, the economy improves. That's a bad chicken and egg argument. A high percentage of owner-occupied homes is a sign of a good economy. If you have owner-occupied homes, that doesn't make your economy good. The reason that happens is because the economy is good. That comes before home ownership. But a lot of politicians began to push for home ownership. Again, you're representing the 8th District of Colorado. If you're able to go before your constituents every 2 years and say, whoa, we've increased home ownership from 33% to 42% with 9 new policies. That policy helps lenders, and again, here's the phrasing, it helps lenders lend money to people who want to own their own home. Who doesn't want people to own their own homes? We shouldn't if they can't afford it. Very simple. Political leaders and direct government policy began to encourage lenders to relax their rules to make mortgages available to people who were not good risks. If the laws of supply and demand are working independent of government coercion, a mortgage company is not going to lend money to someone whom they think might not or probably won't be able to pay it back. That's business. Because if they can't, they lose, mortgage company loses, the economy loses. There are no winners when a home forecloses. But if the government is giving you direct and indirect guidance to back off a little bit, instead of giving them a regular mortgage, a prime mortgage, let's give them something called a subprime mortgage, if that makes you feel better, where it starts off with interest rate like this and then goes up quickly. That way they're lured by that low interest rates for the first 3 years. I can afford that payment. $500 a month, $600 a month, I think I can do that. In a few years it becomes $1,000 a month. You're not worried about 8 years from now because you're human. Subprime mortgages. And again, the lender could make their congressman happy by saying, hey, we had a 15% increase in mortgage loans this year. Congressman says, that's good. I can go to my constituents and say, look at all these good things my policies are doing. And of course, to make the situation worse, a lot of people with their mortgage, they would bundle it into other investments, so your home ownership is tied up in millions and millions and millions of dollars over here as well. Here come the bubble again. October 2007, reality began to set in. A lot of homes all of a sudden did not increase in value as much as the lenders and borrowers had anticipated. The bubble was bursting. In fact, many were worth less than the mortgages that were taken out in the first place. People defaulted. And it came to be known, a new term that I want you to know, toxic assets. We've said that before. Here I have a loan that I gave to John Q. Public here. He owes $200,000 on it. He just defaulted. He declared bankruptcy. I still got this. Somebody's going to pay me too. Maybe not. That's a toxic asset. Foreclose, you sell it to the first Tom, Dick, or Harry that comes along. He says, I'll pay you $75,000 for it. Sold. We got to get something for this. You've lost. Original homeowners lost. The economy has lost. And of course, the trickle of down effect of this is the responsible homeowners also saw their home values plummet, even though they'd done nothing wrong. Follow me back to the Great Depression. What happens then? The banks get tighter on lending money. The classic overcorrection. And now, because there's no money, or less money available for legitimate businesses to expand, to begin, the economic activity begins to slow to a crawl. By early 2008, the government started stepping in because some major banks were going under. This is, again, it amazes me that y'all were just toddlers still when all this was happening. But federal government passed the Economic Stimulus Act in 2008, $152 billion to taxpayers. Yeah, here you go. Here's some more free money we printed. Go spend it. Good. It didn't work. The decline continued. American International Group failed. Bear Stearns failed. Lehman Brothers failed. Meantime, stock prices were falling dramatically. This was becoming as bad as the Great Depression. In 2008, gasoline prices again rose record highs, $4 a gallon. And again, if the price of gasoline is going up, everything's going up because just about everything has to be transported. Treasury Secretary at the time announced a $700 billion proposal, Toxic Asset Relief Project, TARP, where the government, would purchase these toxic assets from the bank and help them out of a bind. The idea is, well, if we can take this burden off the banks, then they'll be more willing to lend money to these businesses, and we can get the economy going again. Where does the money come from to pay for toxic assets? It comes from you and me, either directly or they print more money and inflation. Nothing is free, folks. Nothing is free. There were 3 million home foreclosures in 2008. There was 1 million the year before. Again, the trickle down continued. 2009, General Motors and Chrysler, two iconic American companies, declared bankruptcy. Ford came this close to declaring bankruptcy. And of course, the trickle down continues. The government collected $787 billion fewer dollars in revenue because people were making less. Unemployment reached 10.2%. 25 more banks, including some of the largest in the U.S., lost or went under, including Washington Mutual, the largest single bank failure in American history. Again, the government passed another $800 billion bailout package in 2009. So that's $1.5 trillion that they have spent to try to ameliorate this problem. Are you seeing some of the parallels with the New Deal? The New Deal relied on direct government stimulus and investment in jobs programs and things like that. This was just direct stimulus to businesses, the too big to fail, and to, in one case, taxpayers. $1.6 trillion. So again, that mentality that in an emergency, the government can do a few things that they wouldn't ordinarily be able to do or would be unadvisable to do. The recovery from this recession was painstakingly slow. It was the middle of 2016 before the stock market reached, the Dow Jones at least, reached its pre-recession value. The recovery was very, very slow. It's popular to blame then President Obama's policies for making it slower. I think there's a lot of truth to that, but again, the truth is obviously much, much more complex than that. So I'll ask the question you're probably asking yourself: why didn't they see this coming? Just like the Great Depression, the bubble gets big, it gets big, it gets big. Oh, and it bursts. It always does. Well, some did. Some economists issued some warnings. As a rule, they were ignored. Economists are better at analyzing the past than predicting the future. And again, it is human nature. When you see people who were investing $10 and getting thousands of dollars, you want in on that. Maybe it's greed, maybe not. I don't know. Greed, I've got a very high threshold for calling something greed. Wishful thinking is a powerful, powerful thing. It's going to be the next guy that gets bumped, not me. No, that's going to happen down the road. Was a lack of regulation the problem? Because right after this, we had the Dodd-Frank banking bill, which hamstrung small lenders, which was a terrible piece of legislation. Folks, the 2007 recession did not come from lack of regulation. It came from enticing, quote unquote, encouraging, quote unquote, lenders to break all the rules of supply and demand and issue loans to people who had a very high probability of not being able to pay them. Just so politician A, B, and C can say, look at how home ownership rates have risen under my watch. Ain't I cool? Vote for me in November. Did the stimulus programs help? Well, just much like with the New Deal program, it's impossible to say for sure because we didn't try it without it. Again, if you sling $1.6 trillion at something, somebody, somewhere, somehow, some way is going to be helped. Was it the right thing to do? I personally say no. But, again, we'll never know for sure. Risk is dangerous by its own definition. As we live through history, we are weighing the risks of more than just the economy, but the risks of certain behavior. The economy will recover from this downturn that we're in now. It recovered from the Great Depression. It recovered from the Great Recession. It will recover from this. What will we look like on the other side of this? Will we continue to be a nation whose first glance, when things go a little wrong, is to Washington and not the mirror? Think about that. We'll talk about this on Monday.